All right, let's dive right into this. Today's explainer is all about rolling up the SNDK put and how we can absolutely maximize our premium, especially when the market is seeing red. So $1,087. That's the exact amount of extra premium we managed to squeeze out of a single, highly calculated options roll. Pretty cool, right? Today, we're going to break down the actual mechanics of that trade and, more importantly, the strategic timing behind rolling up a short put. We're getting right into the how and the why here.
And hey, welcome back to the Noob Selling Options channel. If you're looking to move past the textbook theory and get into the real nitty-gritty mechanics of selling options, well, you're in the right spot. We are going to decode this specific trade step by step. So by the end, you'll have the exact logic you need to hunt down these kinds of setups in your own portfolio.
Now, this isn't just hypothetical. What you're looking at are the actual execution receipts for an SNDK put roll with a February 19th, 2027 expiration. This is literally an in-the-trenches, real-world application of rolling up a short put. So let's completely deconstruct what happened here, and we'll start with how we actually closed out the original position. Okay, so you know that to roll an option, you got to buy your way out of the current open contract first. In this specific trade, we did a buy to close on one single contract of the 750 put. Buying that back gave us a debit of $119.93 per share. And since, as we all know, a standard contract controls 100 shares, that means our total capital outlay was $11,993. That's the literal hard cost to extinguish that original obligation so we can actually reposition. But here's the fun part. A roll is a simultaneous transaction, right? So in the exact same breath that we bought back that 750 put, we hit sell to open on one contract of the higher 780 put. Selling that higher strike generated this massive premium credit of $130.80 per share. Multiply that by your 100 shares, and boom, that's a gross cash injection of $13,080 right into the account. So let's just lay out the core math here, because it's actually wonderfully simple. First, you take that massive $130.80 credit you just got from the new position, then you simply subtract the $119.93 debit it cost to close out the old trade. Let the dust settle, and you are left with a net credit of exactly $10.87 per share. Multiply by 100, and there it is, your grand total of $1,087 in net premium collected. Now, this is where the strategy gets really fascinating. The math is pretty straightforward, sure, but in options trading, timing is literally everything. I mean, for most investors, a red day in the market is time to panic, right? But for us, it's basically a shopping spree. So you might be wondering, why on earth would we intentionally wait for a red day, a dip in the market, or the stock to execute this roll? Like, why not just do it on some calm Tuesday when the stock is actually rallying? Well, when the market takes a dip, three specific things happen that create an absolute perfect storm for put sellers. First off, put premiums just naturally spike across the board. Why? Because the underlying stock price is actively dropping toward our strike prices. But it's not just the price movement. Down days almost always trigger a big jump in implied volatility, or IV. You can think of IV as a fear premium. The market gets spooked, and that fear artificially inflates the cost of insurance. And let's be real, insurance is exactly what put options are. And here is the real Delta secret that kind of separates the novices from the pros. Both of our puts, the old 750 and the new 780, got more expensive on that red day. But they didn't increase at the exact same rate. See, the 780 put has a higher strike, which means it's much closer to that current dropping stock price. Because it's closer, it has a higher delta. So for every single dollar the stock drops, that 780 put gains value way faster in absolute dollar terms compared to the 750 put, which is further out of the money and just naturally moves a lot slower. So what's the big takeaway here? By intentionally waiting and rolling when put prices are artificially inflated by fear and a dropping stock price, the actual price gap between those 780 and 750 strikes gets substantially wider than it would ever be on a calm green day. We're purposely capturing that wider spread to absolutely maximize our net credit. If we just rolled on a green day, that fear premium would be totally gone, the spread would be narrow, and honestly, our credit would have been significantly smaller. Now, we all know there's no such thing as free money in the market, right? We've got to transparently balance that reward with the risk. Yes, we absolutely collected an extra $1,087 in immediate cash, but in exchange for that, we moved our strike up from 750 to 780. That is a straight-up increase in our assignment obligation of $30 per share. So if the market really turns against us and we're actually forced to buy those 100 shares, our total obligation just went up from $75,000 to $78,000. Basically, we accepted an extra $3,000 of potential risk just to extract that immediate $1,087 in cash.
And honestly, that is exactly how you strategically navigate this market and really understand the true cost and benefit of your trades. Keep crushing those premiums. Look, if you found this breakdown helpful and you want to keep mastering these core concepts with us, make sure to like and subscribe for more noob selling options strategies. We're all about that focused, actionable learning here. So I'm going to leave you with this one thought. The next time the market is bleeding red and volatility is spiking through the roof, are you going to be panicking, or are you going to be calmly calculating your next high probability, high premium roll? Think about it. I'll catch you in the next explainer.